Dividend Aristocrats are S&P 500 companies that have increased their dividend payouts for at least 25 consecutive years. In other words, these are established, well-run businesses. They are large cap companies with reliable cash flows that they can pay out to shareholders. Think of companies like Coca-Cola. These are extremely dominant businesses that have been around a long time and will continue to be around and generate a lot of cash for years to come. As of July 2025, there are 69 Dividend Aristocrat stocks. Today, I'm going to share my thoughts on each with a brief analysis. These videos take a lot of work, so think of this as a 4th of July special. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using DividendData.com, which is the best research tool for dividend-focused investors. On there, you can get a list of the Dividend Aristocrat stocks that link you right to the stock analysis page. There are also lists of the Dividend Kings, as well as curated lists by me of high dividend growth stocks and high yield dividend stocks. Plus, you get the full stock analysis tool I will show throughout with data visualization, showing the growth of their actual financial metrics over time, including, of course, the dividend. Plus, you can track your own dividend portfolio in the website, including things like your projected dividend income and even your history of earned dividends over time so that you can properly track that growth. And this is just the start of DividendData.com. There are way more features, including a cutting-edge AI analyst that helps make research way faster. And right now is the best time to join because we have our summer sale, which is ending soon. It ends the 4th of July weekend, so now is the time to get it. You can lock in 50% off our annual membership and keep that discounted price for life. This is the best deal we ever offer, and there's a 30-day money-back guarantee, so there's no risk in trying it out. Just use the link in the description and pinned comment of this video. And if that wasn't enough, on top of this great research tool, you get our starter pack that I just created. And this is now rolling out to all DividendData.com members. This is your complete solution to master dividend investing. You get a 60-page report plus a 90-minute video lecture of me going through my entire investing strategy from planning, how I analyze stocks, to then example curated lists of high-quality stocks, depending on what kind of investor you even are. And you get that for free when you sign up to DividendData.com and become a member. Again, right now is the best time to join. This 50% off sale is ending now. With that said, let's get into the video, which I am considering our 4th of July special. Coming up first, we have AbbVie, ticker symbol ABBV. Now you might say, Zach, this hasn't been public that long. How does it have 25 years of history? Well, this is a pharmaceutical company that was a spin-off of Abbott. And Abbott is a dividend aristocrat with 25 plus years of dividend increases. AbbVie has been a fantastic buy over the past decade, though. Current dividend yield is 3.6%, and this is a dividend growth stock. The 10-year compound annual growth rate of the dividend is 12.39%, and the 3-year CAGR is 5.17%. The most recent dividend increase is 5.81%. And based on free cash flow, this dividend is sustainable with a 61% free cash flow payout ratio. And this is why I made it a big point to highlight free cash flow based payout ratio on DividendData.com. Many research websites do not show that. They just show net income based payout ratio. And net income can have a lot of issues with representing the true earning power of a business. As an example, it factors in non-cash expenses like a write-down on an investment. I'm not sure if that's directly what caused AbbVie's net income payout ratio to be so high. But we've seen this with many other stocks over the years, so it's always good to double check based on free cash flow. And if we head over to the AI analyst on DividendData.com and look up its dividend yield, we can see that there has been many years where AbbVie has a 6 and even 7% dividend yield in the past. And even back in 2023, you could have bought it at a 4.5% dividend yield. And this is why AbbVie is loved by dividend growth investors. The total return has been fantastic since it spun off from Abbott. Since 2013, it has a 753% total return. And again, this is that combination of high cash flow dividends and dividend growth combined with earnings growth and stock price appreciation. Stock number 2 I'm going to share today is Abbott Laboratories, ticker symbol ABT. This company is currently trading at a 1.76% dividend yield. And interestingly, that market cap is now lower than the pharmaceutical-based spinoff. This is a dividend aristocrat with a long history of growth. And you can see they did have this 2012 adjustment period, but that was from the AbbVie spinoff. Dividend growth is actually pretty strong with a 9.41% 10-year compound annual growth rate. The 3-year CAGR is 7.87%. And the dividend is sustainable with a 60% free cash flow payout ratio and 28% based on net income this past year. Abbott Laboratories never really trades at that high of a dividend yield. The highest it's been over the past 5 years is just under 2.3%. The 5-year total return's okay at 65%, but if we max that out and go back all the way to 1990, you can see this has been a great compounder in the market with a 7,400% total return. And I'm not even sure that factors in the fact that you would have gotten AbbVie shares in 2013 as well. Next up, we have Archer Daniels Midland, ticker symbol ADM. This is an agriculture company. They have 49 years of dividend increases, and the current dividend yield is 3.92%, which is historically high. As you can see, the stock price has sold off quite a bit from its all-time high, but earnings per share has also followed in that trend. If we take a look at the dividend, you can see this long history of dividend increases. The 10-year CAGR is 6.18%, 3-year CAGR is 8.44%. This has slowed down though. The most recent dividend increase was only 2%. And due to the recent poor performance, the free cash flow payout ratio and net income payout ratio is rising. We currently sit at an 80% free cash flow payout ratio, 54% based on EPS, and right now is one of the highest dividend yields in the entire history of Archer Daniels. Ironically, earlier in 2025, you could have gotten it nearly at a 5% yield, and the only time it even got that close was during the pandemic. Total return's not that great for this one. Since 1990, it has a 1,000% total return. Next up, we have Automatic Data Processing, ticker symbol ADP. This is a great dividend growth stock. As you can see, their earnings per share have grown at a high rate and the stock price has followed suit. And this has largely become a subscription software company. It does have a long history though, as we will see with their dividend payments. The current dividend yield is 2.03%. And this is a company that grows their dividend double digits basically every single year. The 10-year dividend CAGR is 12.13%, 3-year CAGR is 13.98%, and the most recent dividend increase was 10%. This is sustainable too with a 60% free cash flow payout ratio and 58% based on net income. So overall, I'd say ADP is one of those rarer combinations of pretty decent dividend yield in that 2 to 3% range with higher dividend growth. The yield has been much better for ADP in the past. This 2% is pretty in line with the past 3 years or so. But part of that reason is because the earnings growth has become even more reliable and actually accelerated in recent years. Since 1990, the stock has been a great return in the market with an 11,593% total return. Next up, we have another company you'll recognize, Aflac, ticker symbol AFL. This is a great performing insurance company and of course a dividend growth stock. The current dividend yield is 2.21%. As you can see, their earnings per share have grown a lot over time and the stock price has followed suit. And it always trades at a pretty reasonable valuation as well. This is a sneaky dividend growth story though, with a 10-year CAGR of 11.52%. 3-year CAGR, 13.19%. And you can see this has been accelerating. Their most recent dividend increase was 16%. This is a company that has always had a very low payout ratio, but that is growing now. The free cash flow payout ratio is now up to 40%, still very sustainable, but it was just 12% back in 2020. However, based on net income, we're still in a 20% payout ratio range. This dividend yield is on the lower end for Aflac stock. Total return has been very good over the past 5 years. We're looking at 234%. Since 1990, the stock has had a 17,000% total return. Next up, we have Albemarle Corporation, ticker symbol ALB. I might have messed up that name there. I haven't looked at this stock in a while, and it is kind of jumping off the page right now. You can see the stock price is down so much from its all-time high, and their earnings per share have completely collapsed after boom times in 2023. And yes, this is a dividend aristocrat with growing dividends over time. But I'm getting a little bit worried there could be a dividend cut on the horizon. I haven't done a deep dive on this stock. Current dividend yield is 2.49%. Dividend growth is terrible. 5-year CAGR of 1.02%. Payout ratio, unsustainable based on free cash flow basically every year other than fiscal 2022. And in fiscal 2024, net income per share was negative deeply, so it was unsustainable. So we'll see if they rebound and are able to come up with a better long-term plan, I guess. Since 1990, the stock has a total return of 1,400%. They do have a decent balance sheet, $1.52 billion of cash and short-term investments. That is positive $2.1 billion of net debt, though. And for context, they pay $311 million in dividends a year. So they could float this for a while and hope things turn around. If you're interested, though, this could be a buying opportunity. It's one of the higher dividend yields ever, but I would be a little bit worried about that. Next up, we have Amcor PLC, ticker symbol AMCR. As you can see, the stock price has been flat for a number of years. Current dividend yield is 5.55%. This is one of the higher dividend yields in recent history. Total return since 2019 is only 7.3%. I'm not very interested in that company. Next up, we have A.O. Smith Corporation, ticker symbol AOS. This company has a long history of earnings growth, and the stock price has largely followed that. The current dividend yield is 2.07%. And as you can see, this company has a long history of dividend raises, and it actually accelerated quite a bit over time. The 10-year CAGR is 13.6%. 3-year CAGR currently sits at 6.69%. And this is a quarterly dividend that's sustainable. Current free cash flow payout ratio is 40.1%. Earnings per share payout ratio is 35.68%. A 2% yield is historically a good entry point here. Since 2009, the stock has a total return of 1,513%. Next up, we have Atmos Energy, ticker symbol ATO. The current stock price is $152. That gives it a dividend yield of 2.28% at the current price. This is a utility with a reliable dividend payment, but it does have a little bit higher dividend growth than a lot of utilities. The 10-year CAGR is 8.35%, 3-year CAGR is 8.5% as well, and the most recent dividend increase was 8%. Based on net income, the dividend is very sustainable with a 47% free cash flow payout ratio. It is not at all based on free cash flow, but that's typical with utilities. They spend a lot of money. This company also has a lot of debt, which is typical with a lot of utility companies. Although dividend growth has accelerated, it is trading at a very low dividend yield historically. Normally, this is more like a 4% yield. The total return since 1990 is 5,400%. We are finally done with the A's, and now we're on to the B's. We have Becton Dickinson Company, ticker symbol BDX. As you can see, the stock price basically traded relatively flat for about 7 years, and now it has sold off a bunch as of late. Earnings per share slowly grew in that time. The 10-year compound annual growth rate of the dividend is 5.92%. The 3-year CAGR is 6.13%. And their most recent dividend increase actually was pretty high at 9.47%. This is a sustainable dividend as well. The current payout ratio based on free cash flow is 35%, 64% based on net income. And this recent stock price sell-off is giving it one of the highest dividend yields ever for the company. Since 1990, the stock has had a 3,700% total return. The 5-year total return is terrible though at negative 18%. Now we have Franklin Resources, ticker symbol BEN. The current dividend yield is 5.37%, which is high yielding, but historically the stock price has been much higher and likely a lower yield. They even used to pay special dividends at times in the past, although they have not done that recently. The 10-year CAGR of the dividend is 7.87%. This has slowed down quite a bit. The 3-year CAGR is 3.34%. And the dividend is sustainable based on free cash flow, 82% in fiscal 2024. Net income, though, in 2024, it was unsustainable at 141%. As I mentioned, the stock price performance has been pretty terrible on this stock, so the dividend yield is on the higher end it has ever been. We're currently at 5.4%. It hit 7.6% just a few months ago in April during that tariff sell-off. And during the pandemic, you could have bought this stock at a 6 to 7% yield. Since 1990, the total return on this company is 3,000%. Next up, we have Brown-Forman, ticker symbol BFB. The current dividend yield is 3.42%, which I can already tell is historically high. As you can see, their stock price have sold off a bunch. Earnings per share has reliably grown over time. The 10-year dividend CAGR is 6.04%. The 3-year CAGR is 6.31%. And the payout ratio appears to be sustainable with a 48% net income payout ratio. However, it is on the higher end with free cash flow at 97%, and it was 96% the year prior. And as you can see, we're currently trading at the highest dividend yield in recent history for the stock. And that's because the stock price has sold off so much. As you can see, the total return since 1990 peaked at 5,000%, but is now all the way down to 1,700% after this sell-off. And the 3-year total return is negative 60%. Next up, we have Brown & Brown, ticker symbol BRO or BRO. The current stock price is $107.81. That gives it a 0.56% dividend yield. And as you can see, the earnings per share has been growing at a high rate with the stock price following in recent years. In fact, analysts are projecting 10% earnings per share growth in the coming years. This is a financial services company in insurance. As you can see, BRO has had fantastic and consistent dividend growth, and it's actually accelerated in recent years. The 3-year compound annual growth rate is 13.53%. And the most recent dividend increase is 15.38%. This is very sustainable with a 14% free cash flow payout ratio and 15% based on earnings per share in 2024. Since 1990, Brown & Brown has had one of the best total returns of the stocks I've shared today at 39,400%. The 5-year total return is 174%. Next up, we have Cardinal Health, ticker symbol CAH. Current share price is $167, and that gives you a 1.22% dividend yield. The stock has done quite well recently as there is some earnings growth happening. Analysts are also projecting double-digit earnings per share growth in the years coming. This stock, though, has been an absolute stinker in terms of dividend growth. The yield's not very high at 1.2%, and the 10-year CAGR of the dividend's 2.81%. And over the past 5 years, we're lucky to get 1% a year. The most recent dividend increase was 1%. This quarterly dividend is sustainable, though, with a 15% free cash flow payout ratio, and the free cash flow payout ratio is always very sustainable. The net income-based one, though, can fluctuate a lot over the years. Fiscal 2024 sat at 58%. Since 1990, the stock has had a very good total return, though, at 10,000%. And it's been a sneaky outperformer at 270% over the past 5 years. Kind of surprising given their poor dividend growth. And this positive stock price performance actually gives the current yield one of the lowest since all the way back in 2008. Next up, we have Caterpillar, ticker symbol CAT. This is the industrial machinery company you're likely familiar with. You probably see Cat equipment everywhere. Over the long term, this has had very good earnings per share growth and the stock price has followed over time. But it does go through a little bit of boom-bust cycles, which could be buying opportunities if you plan out long-term. The dividend, though, has been consistent with a 10-year dividend CAGR of 6.97%. The most recent dividend increase was 7%, and it is sustainable with a free cash flow payout ratio of 30% and 24% based on net income. Here you can see the range that CAT has traded at in the past in terms of dividend yield. Could have gotten as high as 4% in 2020. But in recent history, you're not really getting this above a 3% yield. The total return is 11,860% since 1990. The 5-year total return is also pretty good at 240%. Next up, we have Chubb Limited, ticker symbol CB. This is an insurance company that Warren Buffett's company Berkshire Hathaway actually started building a stake in. And you see their earnings per share has actually been accelerating in recent years. The current dividend yield is 1.36%, and they have a long track record of dividend growth. The 10-year CAGR is 4.08%, and the 3-year CAGR is 6.63%. Their most recent increase was 6.59%. It's a very sustainable dividend with an 8% free cash flow payout ratio and 15% based on net income. This dividend yield is always between a 1 and 3%. And since 1993, this company has a total return of 5,474%. Next up, we have Church & Dwight, ticker symbol CHD. This is a popular consumer defensive company owning many top brands in household care. The current share price is $98 with a dividend yield of 1.2%. This is a top consumer defensive company with products in household and personal care. That includes well-known brands like Arm & Hammer and Trojan, and they have reliable, slow earnings per share growth. They have 27 years of consecutive annual dividend increases. The 5-year dividend CAGR is 5.82%, and it's actually slowed down a little bit in recent years with a 3-year CAGR of 3.97%. So this is pretty low dividend growth considering that they have a 1.2% dividend yield. The current payout ratio, though, is very sustainable at a 28% free cash flow payout ratio and 47% based on net income. Since 1990, Church & Dwight has a total return of 10,395%. However, over the past 5 years, the stock has not done that well with only a 33% total return. Next up, we have C.H. Robinson Worldwide, ticker symbol CHRW. Earnings growth has been pretty flat in recent years outside of this outlier period in 2022. The current dividend yield is 2.57%, and the 10-year CAGR is 5.02%. The dividend is sustainable with a 60% free cash flow payout ratio and 63% based on net income. If you're looking to buy this stock, it's usually between 2 and 3% dividend yield. Total return's not that great, though. Since 1997, we have a 2,600% total return. Next up, we have Cincinnati Financial, ticker symbol CINF. The current dividend yield is 2.38%, and they recently just had a pretty high quarter in earnings per share. Again, a long history of dividend growth. The 10-year CAGR is 6.58%. The 3-year CAGR is currently at 8%. And the payout ratio is very sustainable with an 18% free cash flow payout ratio and 21% based on EPS. Following the great financial crisis, you could have bought this stock at a 7% dividend yield, but in recent years, it's in that 2 to 3% range. Since 1990, the stock has a total return of 5,700%. Next up on this list of Dividend Aristocrat stocks, we have Colgate Palmolive, ticker symbol CL. They own a lot of consumer defensive brands you'll see in the grocery store, like Colgate, the toothpaste. The current dividend yield is 2.34%, and earnings growth has been pretty flat over the past decade, and the stock price has largely followed that. This is a reliable dividend payer with slower growth. The 10-year CAGR is 3.19%. 3-year CAGR of the dividend is 3.43%. It is sustainable, though, with a 50% free cash flow payout ratio and 61% based on earnings per share. Next up, we have another consumer brand company, the Clorox Company, ticker symbol CLX. This is a company I remember was crushing it during the pandemic, and they have had poor performance since then. The current dividend yield is actually 4.1% because the stock has sold off quite a bit lately. 10-year CAGR of the dividends, 5.13%, and the 3-year CAGR is 1.7%, showing slowing dividend growth. In 2022, they had a 106% free cash flow payout ratio, and then 123% in 2024. And based on net income, the past 3 years have been deeply unsustainable. Yet they have continued paying year after year, which goes to show how the consistent track record of some of these dividend aristocrats allow them to weather a lot of storms, whether it's financially, business disruption, etc. That said, there are still companies that are dividend aristocrats and fall off over time. This current 4.1% dividend yield is one of the highest ever for the Clorox Company. Since 1990, the company has a total return of 2,850%. Next up, we have Cintas Corporation, ticker symbol CTAS. This has actually been a great performer. As you can see, their stock price has been on a consistent growth trajectory over the past decade, and that's due to high earnings per share growth. This is a low yielder, though. The current dividend yield is 0.71%, and this company has a consistent history of high dividend growth. As I mentioned, this yield right now is one of the lowest in recent history, and over the past 5 years, the best you could have gotten this yield was 1.2%. which that's the reality for a lot of companies that are growing pretty fast. 5-year total return for Cintas Corporation is 252%. And then if we zoom out and look at Max, the total return has been fantastic going back to 1990. We have a 25,200% total return. Next up, we have Chevron Corporation, ticker symbol CVX. This is the oil giant that rivals ExxonMobil. Both have those standard oil origins. The current dividend yield is 4.76%. Huge company, huge cash flows, but their earnings fluctuate over time based on the price of oil. Similar to Exxon, though, because they have such great balance sheets, they are actually able to weather those storms and continue raising their payments on an annual basis. The 10-year compound annual growth rate is 4.8%, and the 3-year CAGR is 6.39%. Chevron has actually been raising their dividend at a higher rate than Exxon in recent years. The free cash flow payout ratio is 78% based on fiscal 2024 and 66% based on net income in 2024. This 4.8% dividend yield is actually pretty good historically, but I like to buy these oil stocks during deep bear markets, and you could have bought Chevron in 2020 anywhere from a 6 to even a 9% dividend yield. Since 1990, the stock has a total return of 3,000%. And we just wrapped up the C's in this list, and this is a big Dividend Aristocrat list. So if you want to help support the channel, please go use our summer sale. You can get 50% off annual membership. This is the best research tool for dividend investors. I've been showing it throughout the video, and that is just scratching the surface. So use the link in the description and pinned comment if you want to lock in 50% off. It's the best price we ever offer. Let's get back to the Dividend Aristocrat list. Next up, we have Dover Corporation, ticker symbol DOV. The current share price is $183.30. The dividend yield is 1.12%, so we have another low yielder here. Over the long term, it's had earnings per share growth, but that has fluctuated over the years. The stock price has largely followed suit on that path. Their dividend, though, has remained steady, but dividend growth has slowed down a lot over the past, 7 years. 10-year CAGR is 4.77%, 5-year CAGR, only 1%. And the most recent dividend increase for Dover was 0.98%. That said, the dividend is sustainable, though, with a 48% free cash flow payout ratio. And in the latest year, their net income payout ratio was only 10%. So I haven't dove a lot into their business, but I'm surprised they haven't been growing the dividend more. And if you want a little bit of a fun fact on this list, Dover has been raising their dividend for 69 years, which is tied for the longest streak on that list. Now, I'm going to be fair, I'm not sure if that's entirely correct. I don't have enough stock market history to know if back in the day Standard Oil was raising on an annual basis when it then split into all those oil giants. But this is a low yield company, 1% dividend yield. You could have gotten it at a 3% yield back in 2015. Since 1990, the total return is 5,870%, which is not bad for a slower growth company. Next up, we have Consolidated Edison, ticker symbol ED, another utility company. Current share price is $98. The dividend yield is 3.46%. And if you live in the New York area, I'm pretty sure this is the main utility there. Has a long history of dividend growth, but at a slow rate. 10-year dividend CAGR is 2.72%. 3-year CAGR, 2.47%. So we're really staying in that mid-2 range. The most recent dividend increase was 2.41%. And again, like I mentioned with most utilities, free cash flow payout ratio, never sustainable. But based on net income, you're currently sitting at 60% dividend payout ratio. This company also has a lot of debt. We're talking about $25.8 billion net debt. But that's the way utilities roll. It does provide reliable income if you're looking for that. This stock always trades at a little bit of a higher dividend yield in that 3 to 5% range. But it's interesting, if you go all the way back to the mid-2000s and even during the great financial crisis, 2009, you could have gotten the stock at a 6 to 7% dividend yield. And if we go back to 1990, Ed stock has a total return of 1,900%. Next up, we have Ecolab, ticker symbol ECL. The stock has done pretty well, but it is a low yielder, dividend yield 0.97%. Dividend growth, though, has been pretty good. The 10-year CAGR is 7%, and it's been accelerating with the 3-year CAGR now at 8.42%. The most recent dividend increase was 14%. It is sustainable with a 36% free cash flow payout ratio and 31% based on EPS. Dividend yield's always in this 1 to 2% range. Since 1990, though, the stock has done well, an 11,800% total return. As we continue this Dividend Aristocrat list, we have next up Emerson Electric, ticker symbol EMR. The current dividend yield is 1.58%. Stock price is around all-time highs right now. Dividend growth on this one, pretty terrible though. 10-year CAGR of the dividends 1.16%, and it has not gotten better. It's actually gotten slower. The most recent dividend increase was 0.48%. Payout ratio seems to be sustainable, 41% based on free cash flow, although 2023 was a bad year in free cash flow. Net income payout ratio around 61% right now. Overall, I'm not that excited about this stock. Low yield, low growth. And this 1.6% dividend yield is actually one of the lowest in the entire history of the stock, at least going back to 1990. And this is one I would really not consider buying unless it was like a 5 to 6% yield, given the low growth rates. Since 1990, the stock has a total return of 3,200%. And despite the slow growth, it's actually done pretty good over the past 5 years, 142% total return. Next up, we have Essex Property Trust, ticker symbol ESS. Current dividend yield's 3.6%. Earnings per share has been growing a bit over time. Stock price, though, has been largely trading somewhat flat over the past 8 years. If we take a look at the dividend, the 10-year compound annual growth rate's 5.96%. 3-year CAGR's 5.3%. And based on free cash flow, it's always in this very sustainable 66% range. Based on net income, it was 83% in the most recent year. The dividend yield's usually in this 2 to 4.5% range in recent history. Since 1990, the total return on the stock is 5,676%. Next up, we have Expeditors International of Washington, ticker symbol EXPD. This company has had pretty good long-term earnings growth, although they did have some outlier years, likely due to supply chain fluctuations during the pandemic. This is a freight and logistics company. This company pays a semi-annual dividend payment and has been increasing on an annual basis. The 10-year CAGR is 7.9%. The 3-year CAGR is 4.75%. Most recent dividend increase was 5.48%, which is slowly up from the prior of 2.9%. Free cash flow payout ratio is 29% in the most recent year, and that's 25% based on net income, so very sustainable dividend payment. And the stock is normally trading between a 0.9 and a 1.9% dividend yield. Since 1990, the stock has done quite well with a total return of 17,800%. Next up, we have a new Dividend Aristocrat, which I actually think is probably one of the best stocks on this list. We have Fastenal Company, ticker symbol FAST or FAST. The current dividend yield is 4.19%. And you can see the earnings growth has been pretty high over the past couple decades. Stock price performance has been great. And this company is interesting. I haven't done a deep dive on it. It looks like they have some special dividends that they pay pretty regularly, and then a base quarterly dividend that they raise over time. 10-year compound annual growth rate of the dividend is 12.13%. Free cash flow payout ratio is currently 94% and 77% based on net income. Actually, my dividend yield calculation for that stock may have been inaccurate based on a special dividend, not the base quarterly dividend. Trailing 12 months, the dividend yield has been 2.1%, and it's usually in this 2 to 3.5% dividend yield range. Since 1990, though, this stock has a total return of 56,000%. That's one of the best performers showed so far. Next up, we have Federal Realty Investment Trust, ticker symbol FRT. This is one of the first REITs I actually learned about. I bought it back in 2020. It was a good trade for me at the time, but I have since sold it because of the slow growth. The dividend yield currently is 4.65%. And here's what I mean when I talk about slow growth. The 10-year CAGR is 2.37% for the dividend. 5-year CAGR, though, 0.93%. And they grow at less than 1% a year. When I bought this stock back in 2020, I had around a 5% dividend yield on cost. Since 1990, this company has a total return of 2,400%. 5-year total return currently sits at 36%. Next up, we have General Dynamics Corporation, ticker symbol GD. This is a defense contractor. As you can see, their earnings growth has been pretty reliable over the long term. The current dividend yield is 2.06%. 10-year CAGR of the dividends, 8%. 5-year CAGR is 6.4%. The most recent dividend increase is 5.63%, and the free cash flow based payout ratio is 47.8% in the most recent year and 40% based on net income. So this is a sustainable dividend growth stock. This 2% dividend yield is pretty normal range for the stock. Sometimes you can get some outlier periods in the 3 to 4%. Since 1990, the company has a total return of 10,656%. Next up, we have Genuine Parts Company, ticker symbol GPC. The current dividend yield's 3.42%. The company has a long history of dividend growth with a 10-year CAGR of 5.29%. The most recent dividend increase, though, is a little bit slower at 3%. The dividend's sustainable, but the payout ratio has been rising in recent years, likely due to poor performance in free cash flow. We're at an 81% free cash flow payout ratio now, and 61% in the most recent year based on net income. The dividend yield for this company is typically in the 2 to 4% range, but you can occasionally get outlier periods like 2020 and 2008. There, the yield got up to around 6%. Since 1990, the company has a total return of 2,000%. Next up, we have WW Grainger, ticker symbol GWW. This stock has had surprisingly good performance. As you can see, earnings per share have boomed up and have been around these all-time high levels for a number of years. The stock price has followed that path upwards. This company is not only a dividend aristocrat, but it's a dividend king with 52 consecutive years of dividend raises. The 10-year compound annual growth rate of the dividend, 6.81%. 3-year CAGR is 9.53%. It's a low yielder, 0.88% dividend yield, but the fundamental growth looks to be there. Latest dividend raise was 10.2%. It's a very sustainable payment too, with a 26% free cash flow payout ratio and 22% based on net income. And in recent years, their payout ratio has actually been going down despite increasing their dividend growth. We are trading at a relatively low dividend yield for the stock at 0.9%. Actually, it's historically low, but that's due to the positive stock price performance, which is downstream of their positive business performance lately. In the past, you could have gotten this stock anywhere from a 2 to 3% dividend yield, but that's really the best you would ever do. Since 1990, this company has a total return of 11,000%. The 5-year total return is 259%, so this has been a good performer lately. Next up, we have Hormel Foods Corporation, ticker symbol HRL. This company has not been doing too well lately. Their earnings per share have kind of plateaued and even trailed off in the recent year. And their stock price has sold off quite a bit, which has boosted their dividend yield to be one of the higher ones. It's currently a 3.81% dividend yield. But the big question with this stock is whether they can get their earnings growth to accelerate again in the future. This is a quarterly payer with annual dividend increases, and for a while they were growing that dividend at a very high rate, but the dividend growth was outpacing the growth of their earnings and free cash flow, so the dividend growth has slowed down. The 3-year CAGR of the dividend is 3.71%. The most recent dividend increase is 2.65%. And the free cash flow payout ratio is currently 60%, so it is sustainable. And the net income-based payout ratio is now up to 76%. So you can see what I'm talking about here, where they were growing the dividend, but their payout ratio was growing at the same time in that period. This sell-off has created an opportunity, though, in terms of their starting dividend yield, up to 3.9%. That's one of the highest dividend yields ever for the stock. Since 1990, the company has a total return of 2,700%. Now we have IBM, ticker symbol IBM. The current dividend yield is 2.32%, and the stock price has done fantastic over the past couple of years, which was somewhat surprising. As you can see, earnings per share growth has started to accelerate once again, and analysts are projecting continued growth from here. But earnings overall are still down quite a bit from their all-time high. This is a company with a long history of dividend growth, but growth has slowed a lot at IBM in recent years. The 10-year CAGR of the dividend is 3%, and the 3-year CAGR is only 0.6%. Most recent dividend increase, 0.6% again. The payout ratio based on free cash flow is currently 52%, and in the most recent year based on net income is 102%. If you had IBM on your radar, though, it was kind of a value play for a number of years there. You could have bought in the stock at a 5 to 6% dividend yield, which in hindsight now looks like it was a pretty good buy. But the big question is what happens going forward with IBM. Since 1990, the company has had a total return of 2,800%, but a lot of that was just in the recent years. If we go back to 2023, the total return from 1990 to 2023 was only 1,000%, which is just terrible. The 5-year total return, quite good though now, at 216%. And that goes to show a lot of this just depends on when you actually bought the stock. Next up, we have Illinois Toolworks, ticker symbol IT. Current dividend yield, 2.42%. And it's had pretty reliable, slow earnings growth over time. Stock price has largely followed that. This has been a good dividend growth stock. 10-year CAGR, 11.95%. That's pretty good dividend growth for a 2.4% yield. 3-year CAGR, though, is 7.13%, so it has slowed down a little bit. The most recent dividend increase was 7.14%. Payout ratio is sustainable too, 59% free cash flow payout ratio, 48% based on net income. The dividend yield for this stock usually hovers between a 2 to 3.5% yield. Since 1990, the company has a total return of 8,200%. Next up, we have a popular dividend king. We have Johnson & Johnson, ticker symbol JNJ. They have 61 years of consecutive dividend increases. The Current dividend yield, 3.41%. The recent stock price performance has not been that good, although they did have a spinoff recently, which also will make the list later. It's the newest Dividend Aristocrat, or at least one of them. The dividend growth for Johnson & Johnson currently sits at a 10-year compound annual growth rate of 5.65%, 3-year CAGRs 4.78%, and they just had a recent dividend increase of 4.84%. The free cash flow payout ratio is 59% right now, and 84% based on net income in the most recent year. But if you're a long-term investor looking to get into Johnson & Johnson, that recent poor performance could be your benefit. Current dividend yield of 3.4% is historically high, has not been seen at those levels since 2009 all the way through 2012. Since 1990, Johnson & Johnson stock has had a 4,600% total return, and it was rather reliable along that whole period. Although the past 5 years has been much worse due to the recent poor performance, and the 5-year total return is 26%. Next up, we have Kimberly-Clark Corporation, ticker symbol KMB. They own a lot of top consumer defensive brands, whether it's in toilet paper or Huggies diapers. If you've been following the channel a long time, you know that I used to have a history with this company. I did a big stock review on it, and I had it for a couple of years. The current dividend yield is 3.94%, but as you can see, the earnings and stock price growth has been pretty flat in recent years. Kimberly-Clark is a reliable dividend payer, but the problem is that the growth is not very high. 10-year CAGR, 3.65%, 3-year CAGR, 2.79%. The most recent dividend increase was 3.28%. However, this is sustainable with a 64% free cash flow payout ratio and 63% based on net income. So if you're just looking for reliable dividend income, this stock will do well, but it's probably not going to be a world beater in terms of total return. The dividend yield for Kimberly-Clark is usually in this 3 to 4% range. Since 1990, the company has had a total return of 2,133%. The 5-year total return is 9%. Next up, we have the king of dividend kings, Coca-Cola, the Coca-Cola Company, ticker symbol KO. They have 61 consecutive years of dividend raises. And yes, you probably know Coca-Cola from being one of Warren Buffett's top stocks, but he bought the company many, many years ago, back in the 80s. And this has actually been a great performer in the stock market going back about 100 years. And the company has just continued raising their dividend year after year. It's a very reliable payer. 10-year compound annual growth rate of the dividends, 4.45%. The current dividend yields 2.9%. 3-year CAGR of the dividends, 5.04%. And the most recent dividend increase is 5.15%. Now, Coca-Cola does have a pretty high payout ratio right now, but I would not say the dividend is at risk by any means. In 2024, they had a 176% free cash flow payout ratio, but I would say that's a little bit of an outlier. It was in the 70 to 80% range in most of the recent years. And this past year, the net income payout ratio was 78%. This is a company, though, where they choose to pay out a lot of their cash flows as dividends because they're a very mature business and they have limited opportunities to directly reinvest back into their operations, outside of the occasional acquisition. Coca-Cola always trades at between a 2.5% dividend yield and max really 4%. During the pandemic, you briefly could have nabbed it at like 4.2. The same goes with during the Great Financial Crisis. You could have briefly nabbed it in that 4.2% range. But again, this is a mature business and it's not going to be probably a beater in terms of total return. Since 1990, the company has a total return of 3,291%. 5-year total return's 84.5%, which is not bad. If you're buying Coca-Cola, though, you're probably just looking for the reliable dividend income and the ability for that to grow probably ahead of the inflation rate. Next up, we have Lind PLC, ticker symbol LIN. This company has consistently high earnings per share growth, and the stock price has done surprisingly well in recent years. The 10-year compound annual growth rate of the dividend is 7.6%. 3-year CAGR, 8.63%. This is a low yielder, though, 1.29% dividend yield, and it appears to be sustainable based on their free cash flow and net income payout ratio. FCF payout ratio is 53%, and EPS payout ratio is 40.4%. And because the stock price has done so well lately, this dividend yield's at one of the lowest levels in recent history. Since 1990, the company has a total return of 10,231%. Next up, we have another dividend king. That's Lowe's Companies, ticker symbol LOW. This is the hardware retailer you're familiar with. It's Lowe's and Home Depot, at least in the United States. And this company has a long history of earnings and dividend growth. I actually covered this recently in a dividend raises video. A few times a month, I'll do the latest dividend increases, and Lowe's actually raised their dividend somewhat recently. So go watch that if you want a little more insight. And historically, great dividend grower over here. 10-year compound annual growth rate, 15.67%. But that has slowed down quite a bit. The 3-year CAGR is 4.55%. and they kind of grew it too fast for a little bit in my opinion. It is sustainable though. The free cash flow payout ratio is 33% and 36% based on net income. But this is an interesting stock where they return too much capital to shareholders, to be honest, that it kind of puts the business at risk. They buy back so much shares of their stock. As an example, in fiscal 2023, they bought back 9.73% of their shares outstanding and 7.45% in fiscal 2024. And as a consequence, they do a lot of that with debt. So although the dividend's very sustainable, they probably won't be able to return as much cash as they do right now. Their net debt has grown to $36 billion. This 2.1% dividend yield is, at least in recent history, on the higher end. Since 1990, this stock has crushed it. 37,800% total return. And what that is a combination of a growing business, repurchasing a lot of its shares outstanding, with paying a growing dividend in that time. However, they are in a little bit of a rut. The 3-year total return is only 34.9%. So we'll see if Lowe's is able to re-accelerate their dividend growth again. Next up, we have McDonald's Corporation, ticker symbol MCD, another iconic American brand. Current dividend yield, 2.43%. Earnings per share has been growing at a high rate for a long time. Stock price performance has been very good. Analysts are projecting mid to high single-digit earnings per share growth in each of the coming years. And again, long history of dividend payments. They've been a quarterly dividend payer, then they moved to annual, and then they went back to quarterly. But the key thing is they kept raising it in that time. 10-year CAGR of the dividend, 7.61%. 3-year CAGR, 8.65%. Although the most recent increase was a little lower at 5.9%. I'd say there's very little to no risk of a dividend cut at McDonald's. Current free cash flow payout ratio is 72%, 59% based on net income. They also repurchase shares at a reliable rate. McDonald's never really gets that cheap. In terms of dividend yield, you would be lucky to get this in the 3% range. During the pandemic, you briefly could have gotten it at up to a 3.6% yield. And following the great financial crisis, it was over 3 for a number of years. Since 1990, McDonald's stock has had a 6,693% total return. And that goes to show that a rock-solid business that's already very established and everyone already knows about can still perform well in the stock market. Next up, we have Medtronic PLC, ticker symbol MDT. For a while, this company had a really solid track record of earnings growth. But since 2019, we've kind of plateaued here. And you see the stock price has sold off a lot since 2021 highs and has remained in this $70 to $90 range. Currently, the stock trades at a 3.3% dividend yield. The dividend growth has been a 10-year CAGR of 8.82%. This has slowed down, though, a lot in recent years. 3-year CAGRs, 4.07%. And the most recent dividend increase was only 1.43%. And you can see the payout ratio has even been rising on the stock. In the most recent year, it's a 69% free cash flow payout ratio and 76% based on net income. This current dividend yield, though, for Medtronic stock is one of the highest in recent history. It's only been in this 3 to 4% range in the past couple of years. And prior to that, it only hit a 3% yield twice, and that was very brief. Since 1990, the company has a total return of 7,058%, although the past 6 years have not helped at all with that. 5-year total return for the stock is 10.2%. If you're watching this video and saying, wow, this is a lot of content, I'm starting to remember why I haven't recorded one of these in a while. But some of you in the comments keep requesting it, so I will probably do it every year, maybe every other year. And if you want to support, please go sign up to the summer sale for dividenddata.com. You can get 50% off annual membership, link in the description and pinned comment in the video. You can use all the tools I'm showing throughout. Let's get back to the Dividend Aristocrat list. Next up, we have McCormick & Company, ticker symbol MKC. Current dividend yield is 2.36%. And stock's down quite a bit from its all-time high of $104. Again, it has a reliable track record of growth, although it's slowed down a bit in recent years. 10-year compound annual growth rate of the dividends, 8.45%. 3-year CAGR, 6.74%. The most recent dividend increase was 7.14%. Free cash flow payout ratio just below 70%, and based on net income, 57% in the recent year. The dividend yield for McCormick & Company typically is in this 2 to 3% range, although it got as low as 1.2% during 2020. So I don't know how much of a deep discount it is right now, but it's probably trading more where it's supposed to trade. Since 1990, the company has a total return of 4,800%. Next up, we have a company that is a great performer. That's Nordson Corporation, ticker symbol NDSN. And the stock has actually sold off quite a bit lately, boosting its dividend yield to 1.45%. I wasn't even aware this stock has gone down a little bit. I remember this one though from prior Dividend Aristocrat videos. 10-year dividend CAGR, 13.49%. 3-year CAGR, 15.21%. So the dividend growth is very good, and it's quite sustainable too with a 30% payout ratio. That's on both free cash flow and net income. Nordson is actually a dividend king with 60 years of consecutive dividend increases. And this current 1.5% dividend yield is historically on the upper end, at least in the past decade. Total return since 1990 is actually not as good as I expected from looking at that stock price chart. It is 2,674%. Seems like it did very poor for those first 15 years or so. Next up, we have NextEra Energy, ticker symbol NEE. This is one of the better dividend growth utilities. As you can see, their earnings per share has been growing a lot over time. Current dividend yield is 3.2%, and the 10-year compound annual growth rate of the dividend is 11.4%. 3-year CAGR, 10%. So this is a company that increases their dividend pretty typically at a 10% rate, which is not bad at all for a 3.2% starting yield. Now, this is a utility company, so it's similar to what I mentioned before. They're spending a lot of money every year. So that free cash flow payout ratio is typically very unsustainable, but in fiscal 2024, it's actually 89%. Based on net income, though, the payout ratio is sustainable, 60%. And similar problem with a lot of these utilities where they just use a ton of debt, now up to $87.2 billion of net debt. But to be fair, they are growing their operating cash flow. I've covered this in my NEE stock review videos in the past. As you can see, in the past decade, they've basically doubled their cash from operations. In that same time, though, they've spent nearly double in capital expenditures. This 3% starting dividend yields doesn't seem that bad based on historical metrics. For a while, this was in that 1 to 2% range. If we go back to 1990, the stock has had a total return of 5,890%. Next up, we have Nucor, ticker symbol NUE. This is a U.S. steel manufacturer. It is not U.S. Steel. That's a whole separate company. The current dividend yield is 1.67%. And you can see this is a business where their earnings fluctuate a lot over time. We had a ton of inflation in 2021 and 2022, and this company was raking it in. Since then, though, their earnings have dropped off a bunch, but they did stockpile a bunch of that cash from that time. Here you can see the Nucor dividend. They do increase it regularly, and they had one big increase in that 2021 period. 3-year CAGR of the dividends, 3.23%. Overall, you should consider this to be a low dividend growth stock. Payout ratio is sustainable, 64% based on free cash flow in the recent year, 25% based on net income. The current dividend yield, though, is historically quite low. As I mentioned earlier, the stock price went up a bunch during that period where they were raking in money. During 2020, though, you could have locked in a 4% dividend yield on this stock, so not bad. Since 1990, total return for Nucor, 6,970%. Not bad at all. Next up, we have a company that is loved by dividend investors, at least historically. That's Realty Income Corporation, ticker symbol O. This is known as the monthly dividend company. They even have that trademarked. Current dividend yield, 5.66%. And that's because the stock price has not been doing well, and the total return's pretty much been flat for nearly a decade here. But if we look at it longer term, could be a decent entry point. They do have rock solid, reliable, growing monthly dividends. Albeit it does grow at a slow rate, 3-year CAGR, 3.86%, 2-year CAGR, 2.82%. But as the yield goes up, it starts to look more and more interesting. Based on free cash flow, payout ratio is sustainable, but this is a REIT, so it's a real estate investment trust. Usually you want to look at funds from operation to determine the dividend safety for that. So as I mentioned, this dividend yield in that 5.5 to 6.4% range, that's historically high, especially in the past 5 years. There were periods in the past, though, where you could have gotten nearly 10%, which would have been a great opportunity to lock that in. Since 1994, the stock has a total return of 4,333%, which is not bad considering it only has a 26% 5-year total return. Next up, we have PepsiCo, ticker symbol PEP. I actually just did a full stock review on this company. And of the stocks on this list, if you're looking for reliable dividend income, this might be a good one and a good entry point. Current dividend yield, 4.34%. It's sold off quite a bit from its all-time high. And we'll talk about how high that dividend yield is based on a historical basis very soon. As you can see, their earnings per share do grow over time. And this has been a high-quality dividend growth stock. 7.31% 10-year compound annual growth rate of the dividend. 3-year CAGR, 7.35%. Albeit their most recent dividend increase was a little on the lower end, 4.98%. And we're starting to push the upper limits of that free cash flow payout ratio. But as I mentioned with Coca-Cola, I'm not worried about a dividend cut at all with this stock. They generate very reliable cash flows and can weather any storm and adjust. And they pay out most of their cash flows as dividends on purpose. They have limited opportunities to directly reinvest in their business. The current payout ratio based on net income is 75%. And as I mentioned, this is one of the highest dividend yields ever in the history of the company. In fact, it's never even been above a 4% yield, and now we're in this 4.3 to 4.5% range. Since 1990, PepsiCo stock has had a total return of 2,800%, but that was as high as 4,000% just a couple years ago. And similar to what I mentioned with Coca-Cola, probably not going to beat the S&P 500, but it will provide higher dividend yield and more reliable dividend income that grows probably a little bit above the inflation rate. And historically, it's even been in the 7 to 10% dividend growth. Next up, we have another famous consumer defensive company, that's Procter & Gamble, ticker symbol PG. Current dividend yields 2.64%, reliable earnings that grow at a slow rate. The stock typically trades at a premium valuation as well, similar to Coca-Cola. It does have a lower payout ratio than those two. The 10-year compound annual growth rate of this dividend is 4.77%. The most recent dividend increase was 5%. And as I mentioned, we have a 56% free cash flow payout ratio and 62% based on net income. This is a reliable dividend king. The dividend yield's typically between 2.5% and 3.5%. You'd be lucky to get it at 4%. Since 1990, it's had a total return of 4,230%. Next up, we have Pentair, ticker symbol PNR. This is not a company I'm not familiar with. Earnings growth seems to be pretty flat over time, although the stock price is around an all-time high. Dividend yield's low at 0.97%. 5-year compound annual growth rate of the dividend's 5.64%. So not the highest dividend growth, but it could be worse. It is sustainable though based on free cash flow, 22% free cash flow payout ratio, 24% based on net income. The total return for Pentair stock is 6,200% since 1990, which is actually better than a lot of the ones on this list. Next up, we have PPG Industries, ticker symbol PPG. Stock price and earnings growth have been pretty much flat for a decade. Current dividend yield's 2.38%. The dividend has been growing though in that time. 10-year compound annual growth rate of 6.57%. 3-year CAGR, 4.85%. This is sustainable with an 88% free cash flow payout ratio and 55% based on net income. Since 1990, PPG stock has a total return of 2,600%. Next up, we have Roper Technologies, ticker symbol ROP, and I'm betting that this has been one of the better performers on the list. As you can see, they've had high earnings per share growth and high stock price appreciation. And every time I keep looking at the stock in the past, I like the financials. I don't know much about the core business though. Current dividend yield, 0.59%, so this is a low yielding stock. Dividend growth though, reliable high growth. 10-year CAGR of 12.68%. 3-year CAGR, 9.99%, so right around that 10% range. Most recent dividend increase was 10%. Payout ratio, super low. 13% free cash flow payout ratio, 20% net income payout ratio. This company always has a low dividend yield. It's never above 1%, really. It hasn't been above 1% since 2003. And my prediction was correct. Since 1992, this stock has a total return of 31,172%. One of the best performers I've shared today. 5-year total return, 50.3%. Next up, we have the Sherwin-Williams Company, ticker symbol SHW. And based on the stock price chart, I'm willing to bet it's also one of the top performers on this list. Earnings per share growth, very high over time. Stock price has followed that. Current dividend yield, 0.91%, so this is another low yielding stock. High dividend growth though, 10-year CAGR of the dividend, 13.47%. 3-year CAGR, 9.6%. Low payout ratio too, very sustainable. 34% free cash flow payout ratio, 26% based on net income. This company always has a low dividend yield. Highest you've gotten in recent history was maybe 1.3%. You could have gotten them though in the 2 to 3% range in the great financial crisis. That would have been killer. Since 1990, the company has a total return of 20,682%. 5-year total return, 91%. Next up, we have the J.M. Smucker Company, ticker symbol SJM. This is the owner of Jif peanut butter and like Uncrustables and Smucker's jelly. They are a rather new Dividend Aristocrat stock, and they've sold off quite a bit from their all-time high, so the dividend yield's up to 4.52%. And historically, they had higher dividend growth, but it is slowing down. 5-year compound annual growth rate is 5.37%. 3-year CAGR, 2.94%. And the most recent dividend increase was only 1.89%. Free cash flow payout ratio is 55%, so it's sustainable based on that. Although they had something going on in the most recent fiscal year for net income, so you might want to look into that. And this recent sell-off gave Smucker's stock the highest dividend yield ever in the history of the company. So if you're looking to optimize your yield entry point, this could be an interesting buying opportunity. Since 1990, this company has a total return of 1,270%. Not that good, probably one of the lower ones on this list. Next up, we have a high performer Dividend Aristocrat. That's the S&P Global Inc., ticker symbol SPGI. This is a low yielder, 0.74% dividend yield, but total return's very good with this one. As you can see, their earnings have been growing over time. Stock price has followed that. This company also grows their dividend, at least historically, at a high rate. 10-year dividend CAGR of 11.27%. This has slowed down, though. 3-year CAGR, 4.14%. The most recent dividend raise was 5.49%. This is a sustainable payout ratio, though, with a 20% free cash flow payout ratio and 29% based on net income. Since 1990, this company has had a total return of 15,000%. So pretty solid. 5-year total return currently sits at 68%. Next up on this Dividend Aristocrat list, we have Stanley Black & Decker, ticker symbol SWK. Current dividend yield is 5.85%, and that's because the company has sold off a ton from its all-time high. And its earnings and free cash flow have not been doing well. I'm surprised they haven't had a dividend cut yet, to be honest. So maybe they'll pull through. This is a dividend king with 55 years of consecutive dividend increases. 10-year compound annual growth rate, 4.66%. This has slowed down a ton, as you could guess. The 3-year CAGR is 1.25%. And their most recent dividend increase was 1.23%, and they're probably due for one in the next few months. So we will see then whether they continue this streak. Although their earnings performance has been poor for a number of years, their free cash flow actually has rebounded in 2023 and 2024. And the dividend does appear sustainable based on that free cash flow payout ratio. So they probably don't have to cut it, actually. So this current dividend yield, one of the highest historically, could be a buying opportunity if you're interested. However, total return since 1990, horrific. Now, a lot of that's due to this recent sell-off. Total return, 819%, and it peaked only around 2,400% before the sell-off. Next up, we have Cisco Corporation, ticker symbol SYY. This is not the tech Cisco. This is the food supplies delivery Cisco. Current dividend yield, 2.88%. Recent stock price performance hasn't been that good over the past 5 years, and they did suffer a lot during the pandemic, but they are starting to reach all-time highs on earnings per share and likely free cash flow as well. And they kept paying their dividend all the way through that time and have recently started accelerating their dividend growth again. 10-year compound annual growth rate of the dividend, 6.05%. And this got down to around 2% raises, and the most recent one is now 5.88%, so we're going up again. Free cash flow payout ratio, 46.73% and 51% based on net income, so it is a sustainable dividend payment. And they weathered very bad environments like 2020 where most restaurants were closing down. This stock, you'll usually get it between a 2 and maybe 3.5% dividend yield, but that's getting a little lucky. Since 1990, the company has a total return of 3,960%. Most of that has not been the past 5 years. Next up, we have Target, ticker symbol TGT. I actually just recently made a video about this. It's connected to my Nike stock review video. I cover a few dividend increases. Please go watch that if you want more information. I'll be fast with this one so we can roll through it. 4.6% dividend yield, one of the highest dividend yields ever for the stock. A great historic track record of growth. Bad performance in recent quarters and years. So dividend growth is slowing down a lot. We went from a 10-year CAGR of 8.17%. Most recent dividend increase, only 1.79%. And we've had 3 in a row at that 1.8% range. However, it still is sustainable based on free cash flow and net income. The big question with Target is just whether or not earnings and free cash flow growth accelerate in the future. This could be a good entry point if that happens. Target is a dividend king, meaning they have over 50 consecutive years of dividend increases. And we're currently at one of the highest dividend yields ever in the history of the company, at least going back to the 90s. Total return for Target stock is 3,500%. That's even after this really bad sell-off. It peaked in 2029, just under a 9,000% total return. Next up, we have T. Rowe Price Group, ticker symbol TROW. This is a company I've covered on in the past. Current dividend yield, 5.29%, which is historically high. This is an asset manager, and their core product is mutual funds. So basically, they just take fees off the top. The whole game is assets under management, and then what fees they derive from that. Historically, has been a great business for them, facing a little pressure from ETFs now. It's been a great dividend growth stock. It still has a very good financial balance sheet. The financial health of the company is good. Dividend growth has slowed, though, in recent years due to some pressure and poor earnings, really since 2022. 10-year CAGR of the dividend, 9.34%. 3-year CAGR, 1.19%. Dividend growth may start accelerating in the coming years. And what I like about T. Rowe Price is they have that base quarterly dividend, but every once in a while they pay these huge special dividends as well. Current free cash flow payout ratio, 89%. Net income, 54%. I'm not worried at all about a dividend cut with this one because the financial health of the business is very good. As I mentioned, this 5.3% dividend yield, historically high, never been that high before, other than in the past year. This actually briefly got up to a 6.3% yield. Since 1990, even with the recent poor performance, the stock has a total return of 11,694%. And if we go back to peak prices in 2021, it was nearly a 23,000% total return. Next up, we have Walmart, ticker symbol WMT, the iconic retailer, Sam Walton's company. Current dividend yield, 0.97%. That's gone down recently because the stock price has boomed. They're around all-time highs right now. This is a $776 billion company. Huge. For a while, I didn't really like Walmart stock as a buying opportunity. Their earnings kind of plateaued for about a decade. But now they're starting to see this path to earnings growth. And I'm pretty sure I did a stock analysis video not that long ago, and there were some pretty interesting things going on. They have a growing e-commerce business, and similar to how Amazon's e-commerce business has this huge ads product, Walmart ads is also becoming a pretty big product, and that will be much higher margin than a lot of their other businesses. And they're also building up that whole subscription base with Walmart Plus and all that jazz. So it's getting pretty interesting. If we take a look at the Walmart dividend, they are a dividend king. 50 years of dividend growth, 10-year compound annual growth rate, 3.71%. This has been accelerating though. As I mentioned, their earnings growth is getting better. 3-year CAGR, 7.98%. And their most recent dividend increase was actually 13.25%. So it is interesting how these very old businesses can go through periods of re-accelerating growth again. Free cash flow payout ratio for Walmart, 52%, very sustainable. The net income payout ratio is 34%. As I mentioned, the dividend yield's pretty low right now for Walmart. That's because the stock price performance has been good. Total return since 1990 is 8,000%. Not bad at all. Walmart was already very established in 1990. Was not speculative at all to invest in that. Next up, we have West Pharmaceutical Services, ticker symbol WST. Current dividend yield, 0.38%. This is a low-yielding company. It's down quite a bit from its all-time high, as their earnings per share have been falling from its all-time high as well. If we take a look at their dividend, you can see their annual dividend growth over time. 10-year CAGR, 6.68%. It's around this range. Payout ratio, though, super low with this stock. Free cash flow payout ratio is 21% and 12% based on net income. As I mentioned, this company always has a low dividend yield. It hasn't even been above 1% since 2014. Since 1990, the stock has a total return of 7,800%. Next up, we have ExxonMobil Corporation, ticker symbol XOM. This is another oil giant. I covered Chevron earlier in the video. This is Exxon. They both have origins all the way back to John D. Rockefeller's Standard Oil. These are huge companies. I own this in my dividend growth portfolio. I bought it during 2020 at a great discount. Current dividend yield, 3.62%. And as I mentioned with oil companies, their earnings fluctuate a lot based on the commodity price of oil and gas at any time. However, ExxonMobil has continued being a steady dividend payer and raising year after year, no matter what's going on. And that's because they have this very developed business and a great balance sheet. The 10-year compound annual growth rate of the dividend is 3.09%, 3-year CAGR, 4%. So not the highest dividend growth, and I probably wouldn't be buying at this current yield for Exxon. I like to buy when it's at a deep discount. But the dividend is sustainable. We have a 54% free cash flow payout ratio and 49% based on net income. And here we can see an example of one of these big outlier periods. Not sure if we're going to see this again really in any time soon. Dividend yield in 2020 got up to 8 to 10%. That's when I was buying the stock. Since 1990, ExxonMobil has a total return of 2,800%. If you haven't noticed, I was going in alphabetical order, but at the end, I have some of the newer additions to the Dividend Aristocrats. As an example, this one, which is a sneaky new addition and probably one of the best performers on this list, that's FactSet Research Systems, ticker symbol FDS. If you don't know, this is a financial data company. And as you can see, their earnings per share have been growing at a great rate and the stock price has followed. Current dividend yield is 1%, so this is a lower yielding stock, but it has reliable growth. 10-year CAGR of the dividend, 9.6%. 3-year CAGR, 7.3%. Free cash flow payout ratio is 24.5%. Net income, 28%, so it's a very sustainable dividend. This company is always trading at a lower yield, 0.6% to really 1.5%. As I mentioned though, total return has been great, 12,500% total return since 1996. 5-year total return hasn't been that good though, only 41%. As we start to wrap up this Dividend Aristocrat list, we have another company that's a new addition. We have Erie Indemnity, ticker symbol ERIE. Earnings growth has been pretty good lately, 1.6% dividend yield. This is an insurance company. Dividend has been growing at a 7.2% compound annual growth rate. 3-year CAGR, 7.14%. Payout ratio is very sustainable, 48% based on free cash flow, 39% based on net income. Total return for Erie stock is 4,000% since 1995. All right, the penultimate stock, second to last, we have Eversource Energy, ticker symbol ES. Dividend yield, 4.75%. Stock has sold off quite a bit from its all-time high of $98. Earnings per share recently hit an all-time high in quarterly earnings per share. If we take a look at the dividend growth, pretty good. 10-year CAGR, 6%. 3-year CAGR, 5.68%. Based on free cash flow, that payout ratio, never sustainable, probably utility, don't know this company. Earnings per share payout ratio, 123% in the latest quarter. Probably want to look into this stock more. Total return since 1990, 1,067%. Not very good. Finally, the last stock on the Dividend Aristocrat list, this was added just in the past couple years, and that's from the spinoff of Johnson & Johnson. It's called Kenvue, ticker symbol KVUE. This owns a lot of the consumer brands that Johnson & Johnson used to have. Think like the Johnson's baby powder or whatever, and like the lotions and shampoos. Current dividend yield, 3.93%. Growth hasn't been fantastic since it spun off. They have had some dividend increases though. As an example, they had this 2.5% dividend increase. Not a lot of history to go on here. We'll see if this even continues being a dividend growth stock. I don't like these spinoffs being included a lot of the time, but it is on the list. So those are the 69 Dividend Aristocrat stocks as of July 2025. I hope you enjoyed this video. You can skip around, there's timestamps throughout it. And if you want to support the channel, because this was a long one, please sign up for our summer sale to get access to dividenddata.com. I used a lot of the tools throughout the video, so you probably learned a bit about the platform. Not only do you get all these research tools, you also get our portfolio tracking tool where you can automatically import your brokerage as long as it's a US brokerage, and it will give you stats that a lot of brokerages don't have, like your projected dividend income, and you can have all your different accounts in one place, easy to look at. You also have this starter pack, which was just made available to all dividenddata.com members. And you can think of this as a plan to master dividend investing. It includes this big research report plus a 90-minute video lecture. And in that report, you not only get like how I think about stocks and analyze, but you also get curated lists of great dividend growth stocks, high yield stocks, reliable income stocks. Plus you get ETFs that pay dividends as well. So thank you for watching this 4th of July special, I guess I'll call it. Sign up, 50% off annual membership. Summer sale is ending soon. It's the best deal we ever offer. You can get a 30-day money-back guarantee, so no risk in trying it out. And you get to lock in that discounted price for life. And if the tool helps you find just one better investment, then it way more than pays for itself. So feel free to try it out. Thanks for watching. Subscribe to the channel. I'll see you in the next one.